Check. Welcome back, everyone. Welcome back to the show. I want to give a very special thank you to Michael Wasserman. Thank you, Michael, for your tip, and I also want to thank Peter Louis for joining our patronage for being a new Patreon. Thank you so very much. I thought we'd take a little bit chill because today is Friday, and we'd go ahead and just go through the Arthur Hayes BitMEX blog post that just came up. If you don't know Arthur Hayes is the founder of what was the first major leverage exchange for crypto, which was BitMEX. It came out in 2014. He started getting interested, Arthur Hayes, in Bitcoin in 2013 after reading the Satoshi white paper, according to Wikipedia. But he had been trading after graduating from the Wharton School of Business, I believe University of Pennsylvania, BS. He had been trading with Citigroup and Deutsche Bank, and he decided to begin this exchange where you could go short, long Bitcoin, other cryptocurrencies nowadays. And he is known for his blog post that he puts up whenever he really feels like it on the BitMEX blog. And these blog posts are just full of witticisms. He's got a very brilliant mind, and he makes calls sometimes with what's going to be happening to crypto. What's up, Josh Davis? Thank you for being first. Hey, Josh, nice to see you, man. So he has gone ahead apparently and made a call where he thought that ETH was going to be hitting over $20,000 by the end of the year. Great to be back, Josh. It's great to have you back as well, man. So apparently now he might be a little bit of a crazy person for his calls. Some are saying that he's in fact finally lost his mind. Maybe he's fell off the rocker or whatever you want to say about him. But he still seems to have a sharp mind when it comes to writing. And he wrote this latest blog post talking about all sorts of things. He gets into their various markets. He gets into talking about AI and technology at the end. He talks about NFTs. So I thought it would be fun. Friday, we chill out and we just read the entire thing. Take it kind of like a podcast where you just listen in the background. And I'll be here with you just reading it out. Since it's not too much going on when it comes to the news today, yeah, I guess the prices are not looking too miserable today. We didn't get a drop off, which is nice to see. Let's see. Let's take a look actually real quick. So we have Bitcoin up 0.7% in the last 24 hours, still over $20,000. It's $20,530. And we have Ethereum at 1,090.60. So not below 1,000. And that is up 2.3%, although that's pretty nasty. 7 days down 39%. That's catastrophic. But we do have the merge coming up. I've heard that it's going to be coming up as soon as perhaps August. So that would be something that I think that could surprise the markets, especially if we are seeing capitulation. Some are saying that this was capitulation and we may see a bottom in stocks and risk assets, and that might be good for crypto as well. So this could be an opportunity to be buying. I'm not sure. You let me know what you think is going to be going on. I think it's better to be diversified. I hear a lot of the major players are in cash at this time, although who knows if they're actually buying at this point. Yeah, what else? Oh yeah, I was just before we get into the post real quick, I was apparently Twitter famous today. I logged into Twitter. I try not to go in as much, but the first thing I saw was that Richard Hart had called me out. He said, "I warn people, they don't listen. Then they lose it all. I wish they would just listen. I tried to save crypto's news." This is December 16, 2019. Creating token to pay out interest. Wouldn't a CD equivalent be in stable coins? I think I'd have to agree there.
Yeah,
I mean, I'm
lol,
thinking about it.
lol. So you guys like counterparty risk for 7% is what you like, right? You like giving up your keys. You like to give up your fucking keys for 7%. You understand that when you run one of these stupid fucking services of which you're describing, there's a buyer's order book side, a seller's order book side, and then a counterparty that handles the order matching, and you get fucked with scam wicks and they run off with all the money, right? So you give your keys to BlockFi or Celsius, and they give your keys to fucking BitGo or Gemini. And then they say they're going to pay you some rewards if the government doesn't seize your coins, and if there's not a technical failure, and if BitGo doesn't run away with your coins.
He's right.
For 7% in crypto. Bitcoin's up 700,000x, which is 7 million%. And you fuckers are risking your whole stack for 7%. Doesn't seem wise to me. Hex solves that by having trustless interest, which is likely to appreciate more. Because in those systems that you're talking about, since everyone's just sitting on their fucking coins and not using them anyway, lots of people
Send
are
about
happy
Celsius.
to take that counterparty risk. And you know what it does? It drives the return down.
Or
So they
BlockFi.
used to be offering 14%, and now they're offering 7%. And I wouldn't be fucking surprised if in 2 years they were offering 3 or 4, because people are so stupid. They love to give up their private keys. They love it. They just can't wait to give up their private keys.
What if I just use Cardano or like Tezos instead and call that a CD?
Then you can do that. There are proof of stake products which give you a yield. You can get yield in Bitcoin by buying mining hardware. You usually lose. You can get yield in proof of stake. You can get yield in masternodes. The difference is they are not the same product. They don't pay you more if you lock longer, and you can dump whenever the fuck you want. In Tezos, you have to wait 22 days to dump. That's not the same product. They're competing. They're different products.
Fair enough. Yeah, completely different feature sets on the other side. Yeah. Okay.
Not completely different, but we pay more if you lock longer, and that's what a CD does, and none of those do.
Richard. You know, it's funny because I had not watched that video until right now, so I had no idea what he was talking about. I just saw that there was quite a bit of drama that was blowing up around it. I'm like, okay, well, I understand. He's basically saying that he said this on my show. He was talking about Celsius and the risks with these centralized intermediaries, which he's absolutely right, and which I knew at the time as well. I mean, but YOLO, right? I mean, people are still taking risk. There's apparently a master key that maybe Richard holds, maybe he doesn't with Hex, which we all know. He's at least been a benefactor, and he hasn't pulled the rug. So in a way, he's been a safer custodian, we have to admit, than Celsius. All I can do is laugh about it right now. I'm not here to shame this way or that way, but just what I mean, it blew up apparently that he said that in reference to me talking about how I lost quite a lot in Celsius there. And yeah, I guess the Hex community took that over. The Hex community has been all over my Twitter for some reason. I think it's just because Richard's been talking about it. But, you know, it's all love. It's all love. At least he has, again, treated people right. And he's operated Hex in, I think, a smart enough fashion as he could do. So I'm not going to go into bashing whether to buy it or not. I still have whatever Hex somebody gifted me on this show a long time ago. I haven't sold it. Satoshi has not pulled the rug. There you go. Podhead knows what's up. Satoshi could just as well pull the rug. That's kind of going along with what I was talking about last time when it comes to trusting. We should probably share the show, right? I haven't even shared this live stream. Real quick, let's do that together. Ooh, if you guys could retweet it, this would be epic. Let's go ahead and we're going live. Going live. Okay. Well, we're already live, but might as well retweet it or might as well tweet it. So yeah, we're going to be covering Arthur Hayes' blog post. Just wanted to show you that little bit drama that I saw. It's all love, man. At the end of the day, it's about your fellow man. And at least we could say that Richard Hart has been trustworthy as a custodian, better than others. So there's that. And yeah, that's the best that I can say. It's all love. So floaters, Arthur Hayes, 16th of June, 2022. Grab yourself a drink. I'm drinking today Stash. I'm drinking Stash Premium Japanese green tea. It's based on Japanese green tea or flavors. I'm not entirely sure, but this delicious stuff. And I'm trying not to have too much caffeine, so this is just perfect for me. Enjoy whatever you want. And like I said, this is going to be more of a just podcast style thing or reading Audible, where I'm just going to read the whole blog post and hopefully you take something away from it. Or we'll see how far we do get. Damn. Pilling the live shows. Yeah, it's all an illusion. We're going to be pilling the live shows for sure as we go along. Everything is an illusion, even space-time. Yeah, we're not going to get into that one. Anyway, any views expressed in the below are the personal views of the author, Arthur Hayes, and should not form the basis for making investment decisions, nor be construed as a recommendation or advice to engage in investment transactions. Sometimes you just want to experience pain to remind yourself that you still exist. Maybe that is why I thought walking onto the University of Pennsylvania rowing team was a good idea my freshman year. I was not good, and I only lasted a semester. And this is mostly because I did not appreciate that being a good rower requires 6 days a week of self-inflicted corporal punishment. The Penn Boathouse sits on the picturesque banks of the Schuylkill River, When practice was on the water, I rode my dilapidated bike 2.5 miles each morning or afternoon to practice. We were advised to purchase inexpensive bikes as theft was quite common in and around campus. To me, the highlights of my short-lived experience on the crew team were the rare moments on the water when my boat of novices got it. Whenever we were harmoniously gliding across the placid waters with the sun rising over downtown Philadelphia, I sincerely appreciated the beauty that rowing brings to the human experience. But it was a dichotomous experience, as the life-affirming serenity of human bodies exerting themselves in a rhythmic fashion sometimes gave way to the other side of the coin, death. Periodically, decomposed human bodies, which we affectionately refer to as floaters, surfaced next to us intrepid athletes. Some had likely gone to their watery grave voluntarily, and others were wearing the latest fashion of concrete foot apparel. But regardless of how they got there, after these individuals had spent sufficient time submerged under the cloudy depths, some unfortunate rowers would discover a silent, waterlogged companion floating next to them. Just like on the Schuylkill, there are floaters lurking just below the surface of the capital markets. Ooh. There are companies or hedge funds that seem to be getting along fine until some calamitous volatility event fatally compromises their ability to remain a going concern. To the untrained eye, these zombies might have appeared to be alive and well, but they got deaded a long time ago by unsustainable business models and trading strategies. This past week witnessed the lightspeed bankruptcy/insolvency of a few high-profile business and hedge funds that previously were thought to be masters of the metaverse. Unlike the human dead, the living dead of capital markets carry their possessions with them into the river Styx, bobbing just out of sight underneath opaque waters. It is only once their souls finally succumb to their macabre reality and market conditions force their carcasses to the surface that these companies' worldly possessions are unearthed and ultimately auctioned off in a fire sale. For those intrepid living capital market explorers who possess the resources to harvest the fruits of the dead, the capital market zombie apocalypse is welcomed. During the first sale of the dead, pristine assets with solid fundamentals suddenly become inexpensive, but beware, not all assets are made equal. Many of the zombies' possessions deserve to travel with their hosts down to the underworld. It requires the utmost discipline to separate what is irrationally cheap from what fundamentally deserves to perish. The key determining factor is always cash flow. I know that in this new era of life-changing technology, such pedestrian concepts of cash flow seem banal. However, when we enter the sepulcher, we must be like Indiana Jones in the Holy Grail, eschewing obvious beauty for the plain value of projects or businesses with real cash flows driven by strong usage. So anyways, you guys tell me if you think he has lost his mind or not, finally. Now, keep in mind, he always kind of writes poetically like this. But as we go along, let me know if you think he's lost it. Voyager News. The time is upon the faithful to sow seeds for the next bull harvest. The time is now to rediscover the merits of category-defining DeFi projects and decentralized applications, dApps, that are being dumped indiscriminately alongside copy-pasta trash. There exists a universe of projects that are category leaders in the substrate that will allow the faithful to construct an entirely new decentralized financial system. That's really what we're doing here, engineering a new financial system. Ebbs and flows. These projects have the following characteristics. They are down 75. So he's saying that there are a lot of really good projects that are being perhaps oversold here that might be quality, and this is the time to pick them up. They are down 75 to 99% from their late 2021 all-time highs. 2, they have actual users that spend real capital to access their services. What are these services he's talking? They are the first projects defining how key DeFi services should be offered. Let us walk through the valley of darkness and scoop up the discarded baubles of the funds that are no longer with us or are not long for this world. These zombies are in the process of liquidating a significant number of assets so that they can meet margin calls and investor redemptions. Duration mismatch. So Celsius, this is the tweet, the famous tweet, pausing all withdrawals, now famous, swaps and transfers between accounts, yada yada. What happens when you borrow short-term money but lend/lock up funds over the long term? This is the cause of just about every banking-led financial crisis. Prior to the 2008 global financial crisis, or the GFC, Goldman Sachs, Morgan Stanley, Merrill Lynch, Bear Stearns, and Lehman Brothers were true investment banks. They did not accept retail deposits, which meant they had a freer hand to pursue riskier and more lucrative business lines. During my stint at undergrad business school, landing a gig at one of the true investment banks was the dream. Commercial banks like JP Morgan and Citigroup were thought of as one rung below. Fast forward to September 2008, and every single investment bank who borrowed in the wholesale short-term debt markets but effectively lent long-term either took a government bailout, was bought by a commercial bank, or went out of business. The crypto flavor of this in 2022 features firms that borrowed short-term money at high rates from retail hodlers and locked it up long-term into DeFi yield farming strategies. Howoo! Calling the Luna Wolf Pack. When retail recently demanded their capital back, the duration mismatch destroyed these companies' business models. BlockFi sold equity first, and therefore sold it best. They procured additional financing at a 66% discount to their previous round. Ouchie. But at least they did not have to halt withdrawals. While Celsius is the highest profile floater, there are other cadavers that will wash up on the shores of the crypto river Styx. Every morning, my Telegram is lit up with so-and-so telling tales that such and such company engaged in crypto lending is fini. Those who do not study history are doomed to repeat it. There is nothing special about this business model except that somehow these companies were able to trade at astronomical price-to-book ratios. Thank you, venture capitalist money. Keep pumping the market full of that fee-adjusted beta. As this cohort of firms is forced to puke out any asset that is not locked in some long-term yield strategy, look out below. More indiscriminate selling of all liquid assets on their loan books will occur, so these lending firms may return assets to the retail depositors. The calendar. In Shut It Down, I laid out my thesis for why I believe the market bottomed shortly after the Terra USD TUSD it's not USDT, whatever. Anyway, Terra USD led crypto market implosion. I also described my views that while I believe the bottom was in, that didn't mean the market wouldn't retest those levels in the short term, as the high clergy of finance wields their flaming sword of rate hikes to cool rampant inflation. The universe, the earth, nature, and ultimately humanity moves in cycles. For money managers, the quarter-end cycle is extremely important. Due to the way in which results are reported and redemptions are processed, quarter ends take on extreme importance. It is obvious to all that for many crypto asset managers, the second quarter was disastrous. As the weeks drag on, the markets will continue to see investor letters and regulatory filings describing the magnitude of losses incurred by funds and businesses on the back of the crypto capital markets shedding close to 50% of its value over the second quarter. Humans react poorly when presented with losses. The majority responds by demanding their capital back, regardless of how it diminishes long-term prospects for profit. I can only imagine the flood of redemption requests many funds are processing as the quarter draws to a close. Compounding the issue is that unlike many alternative assets, crypto trades 24/7. There is always a price, which means investors can watch their capital evaporate in real time, all the time. There is no excuse for a fund manager to delay exiting any positions that still have value. A short primer on hedge fund bats. Oh, happy to have you back as well, Beached Whale. Oh, I remember you. What's going on? Hey, Easy Money Sniper. Have a good weekend yourself, Vic. And everybody else, if I don't catch you this weekend, I hope you have a fantastic one. So, a short primer on hedge fund mats. I also must add that hedge fund mats will exacerbate the closure of funds. Given that most crypto hedge funds are below their high watermark, it makes financial sense for the manager to close Fund A, but then raise a new Fund B. This simple example will illustrate why. Imagine investors gave you $100 in January, and you put all your money into the Terra USD carry trade. You were able to exit the trade and only lose 50% of your money. Your capital is now $50, but you cannot charge any performance fees. You can only charge performance fees once you return your capital base back to $100, which means you must double your assets. That is hard work, which pays you nothing. Versus, after you lose the $50, you close the fund and liquidate all remaining assets. You then raise another fund. If you turn $50 into $100, you get to charge performance fees on the $50 of profit. This is hard work hard work which pays you well. The yearly linear, I wish crypto was nicer sometimes, really. The yearly linear return payout structure of hedge funds means that investors are always short volatility at the discretion of the hedge fund manager. The path dependency does not favor the investor. Bringing it back to the current market situation, it makes more sense for a manager to close their current fund, liquidate all assets, then raise another fund. Hide your name a little bit. Don't give it the same name for the fund. Just pretend that never happened and you weren't associated with that old fund that lost money, and purchase the same assets at bargain prices in a few weeks/months time. This allows them to actually profit from the revival of the crypto market. However, it does bring more sell pressure to the market in the short term. During this last bull market cycle, capital flooded into institutional money managers who offered some flavor of a DeFi fund. Most times, these beta chasing outfits just bought the market leaders in various categories. That includes lending, proto crypto, banking, both spot and derivatives, decentralized exchanges, NFT marketplaces, and decentralized domain name service protocols, just to name a few. To bolster returns, many of these funds engage in the mother of all carry trades, powered by Terra USD. The weekend after Terra USD imploded, I pulled up my screens and was shocked at how many of what I consider to be the best DeFi projects were down 50% from a few days earlier. These projects were not analogous to Terra USD. My conclusion was that many DeFi funds had such large exposures to UST via earning 20% on Anchor and Luna that they had to sell everything in their books to meet capital class stemming from losses on Terra, ecosystem, coins, and projects. I mean, incredible that something like that could be so impactful across the whole space. But that's what happens when you get most of these funds that are born during the bull market and really don't have much experience and are just, right? As the lotus takes nutrients from the swap and creates beauty, I knew it was time to strap on risk in the face of this Terra USD calamity. My mental motto is simple. I want to own things that power the basic financial services of DeFi. These services previously traded at nosebleed price to earnings ratios and were now deeply discounted. If I fundamentally believe that the usage of DeFi will grow over time, then I must get long all the key financial service providers at these levels. Just because something is cheap on day one doesn't mean it can't get cheaper as time drags on. As I rode through the river Styx, I fully expect to encounter more floaters. These floaters will puke tokens as their portfolios are forcibly unwound. In light of this, I tempered my initial excitement and revisited the macro. The Fed just started the reduction of its balance sheet this month. The ECB will shortly enact its first rate hike. Side note, maybe Lagarde, the head of the ECB, the European Central Bank, maybe Lagarde should take a break from thumping the merits of crypto and focus on alleviating the inflation-induced poverty in the EU that her August body is responsible for. By the way, I did read that the Fed gave out a note today talking about how stable coins and Fed Now, so the Federal Reserve's whatever the heck that monster is, or I don't know if it's a blockchain, I don't know if it's another database, but that's going to be coming out in 2023. But there are also going to be potentials for cryptos and stable coins to be playing a role. I mean, stablecoins are cryptos, but you get what I'm saying. So that was said today. Given the likely fallout of these events, and as I look at the Northern Hemispheric summer calendar, there's one particular weekend that strikes me as a likely candidate. So this is what's kind of blowing up on social media in regards to Arthur Hayes writing this, is that he's calling this right now. There's one particular weekend that strikes me as a likely candidate to host a final showdown between panic sellers and a bidless market, the weekend of July 4th. By June 30th, the second quarter end, the Fed will have enacted a 75 basis point rate hike and begun shrinking its balance sheet. July 4th falls on a Monday and is a federal and banking holiday. This is the perfect setup for yet another mega crypto dump. There are three ingredients to this humble pie. 1. Risk assets will again rediscover their dislike for tightening USD liquidity conditions sponsored by the Fed. 2. Crypto funds must raise fiat to satisfy redemption requirements by continuing to sell any liquid crypto asset. And 3, no fiat can be deployed until Tuesday, July 5th. June 30th to July 5th is going to be a wild ride to the downside. My 25,000 to 27,000 Bitcoin and $1,700 to $1,800 Ether bottom levels lay in tatters. How low can we go? I believe we'll find out on this faithful weekend. This week, Bitcoin and Ether bounced off $20,000 and $1,000 respectively in an impressive fashion. Can they hold a renewed attack on these levels during a weekend where no fresh, filthy fiat can be deposited on crypto exchanges? We will find out if Arthur Hayes is right on July 4th. Hey, what's up, Dennis? Nice to see you, man. Thank you for showing up. And it is a great read. It's fun to read his stuff. While Bitcoin and Ether hopefully won't get much cheaper, it will be Goblin Town for the rest of the shitcoin complex. The rest of this essay is a study in why I have faith in a small subset of protocols that actually have real use cases and users willing to pay real money for DeFi financial services. Caution! Just as I own Bitcoin and Ether, I own every shitcoin featured below. Do not take this as financial advice. Rather, I implore you to critique my thought process and challenge yourself to find value during these trying times. Cream. Cash rules everything around me. That's something that I heard as a young tot in New York City. Wu-Tang for life. And Wu-Tang is heavily into crypto too, so we're allowed to say cream. Hey, thanks, Keith. Nice to have you too, buddy. When in doubt, return to basics. I don't like to say buddy, actually. I'm gonna take that back. I feel like when somebody calls me buddy, it's kind of belittling. So I'll just say brother. Thank you, Keith, for welcome back, brother. When in doubt, return to basics. In its end state, every business must generate cash flow. Even when tech investors focus on user growth at all costs, they're expecting that these acquired users can eventually be monetized in some fashion. Successful DeFi protocols offer a service to users, and in return, users conduct some activity that nets money for the DAO controlling it. Paying users to participate by issuing tokens works to an extent, but users must be willing to part with scarce capital for the service. Otherwise, it is just an exercise in Ponzinomics. There are a few marquee projects that rose to prominence in their respective verticals during the DeFi summer of 2020. As of today, these projects actually have users and robust protocol revenues that at the direction of governance token holders are distributed in various ways. A plethora of projects followed and attracted large large sums of investor money by imitating the successful business models of pioneering projects. But many think like Sushiswap and Cat Swap and Dog Swap and all the swaps that came. But many have failed to attract actual users and usage. So Uniswap was the first one, then it was Sushiswap, and then it was just the entire horde. Unfortunately, financial services lend themselves to natural monopolies quite easily. In most of these major DeFi verticals, there are only 3 to 5 that are regularly actually used by users and actual users and are generating real revenues. Because of this, the protocol value of challengers will likely quickly trend to zero as this bear market drags on. So, I mean, just by context, he does expect this to continue for some time. He expects a lot more death here. Underpinning this analysis is a critical assumption. As every one of the projects analyzed is built on Ethereum, I assume that over time, the number of Ethereum wallets will continue to expand exponentially. Oh, we got an Ethereum fan here. Therefore, I expect that the total addressable market that can use these DeFi services will continue to grow. This gives me confidence that DeFi will not wither away and die. And I can apply mean reversion thought processes that guide me to determine which projects look attractive relative to their past performance. It also allows me to assume that the total fees generated by these projects will continue to expand, even if there is a short time period where activity and revenues fall or stagnate due to this current bear market. I will make use of the token terminal services to chart price to earnings, PE multiples, for all the projects discussed. Price equals fully diluted market cap. So he's using the fully diluted market cap. Earnings equals last 30 days of on-chain fees that accrue to the protocol annualized. For example, if the shitcoin protocol earned $100 of fees in the last 30 days, that would annualize to 100 times 365 over 30 days equals $1,267 in earnings. And sales equals last 30 days of total on-chain fees charged for the service annualized. This, in some cases, will be higher than earnings, as some protocols distribute a portion of fees directly back to liquidity providers. Crypto's so complicated sometimes. to price. The decentralized exchange, DEX. Uniswap is the largest DEX by average daily trading volume. The design of this protocol is the most beautiful piece of decentralized finance. She's getting like kind of a hard on for is the most beautiful piece of decentralized financial technology ever created. Of course, Uniswap was not. And I'm not gonna lie. I love Uniswap. I'm not talking. I'm just joking here. I love Uniswap. I love Uniswap. I even got. If that's what I use. Of course, Uniswap is not the first decentralized asset swapping service launched on Ethereum. Either Delta and a few other projects came before. However, the team at Uniswap took the proto-spot DEX and transformed it into the most game-changing DeFi primitive created thus far. Uniswap at its core offers a service that allows for the creation of user-directed liquidity pools, or LPs, to swap one ERC20 asset for another. Those are Ethereum tokens. If somehow you're not familiar, the protocol charges a fee that is split between the liquidity providers and the protocol itself. The automated market maker, AMM, uses a constant product curve to determine the clearing exchange rate based on the intended trade size. I'll do it later. I should probably take and copy and paste this. This is a great definition of Uniswap, which can be difficult to explain. But let me start that sentence over. The automated market maker, Uniswap, AMM, uses a constant product curve to determine the clearing exchange rate based on the intended trade size and the amount of total liquidity, all on each side of that trade across a pair. All interactions with the protocol are fully transparent because they are on-chain. This completely changes the microstructure of the market. I believe that DEXs are the future of trading when it comes to non-professional trading houses. I see that because the evolution of centralized exchanges tend towards a market where flows are dominated by a few large high-frequency trading firms, or HFTs. Due to their outsized trading volumes, these firms dictate the policies of centralized exchanges. As time passes, crypto centralized exchanges will resemble their traditional FI counterparts more and more. The market becomes not a race for price discovery based on disparate views of profit-seeking human traders, but a race for supremacy in technology infrastructure spending. For the first time ever, retail traders have at least a choice in the type of platform they choose to trade on. The sexes, centralized exchanges, will adopt policies that favor high-frequency trading firms at the expense of retail traders, and I predict that the decentralized exchanges will cater toward policies that better engage retail traders due to their community ownership model, enabled by governance tokens and DAOs. Both crypto sexes and DEXs will continue to grow their trading volumes, but I believe they are not competing for the same type of order flow, which leads me to believe that both can grow together as the crypto capital markets reach a wider audience of traders. Sushiswap is a fork of Uniswap, remember? Anyway, I guess he's just talking. I'm probably gonna have to just skip through this because he's just talking his entire book. So he talks about Sushiswap. He says that he prefers to buy the market leaders. So I mean, I'll just link the entire. You guys can read the rest if you want to. I'm not going to run out of breath here just reading the entire thing. But he gets into the trading volumes with Uniswap, Sushiswap, compares them to traditional exchanges, as you can see here. GMX trading volumes, blah, blah, blah. Oh, wait, we get into ENS. This is interesting. So let's go to this, actually. Decentralized internet. Shouldn't the world's decentralized computer help host the decentralized internet? Decentralized computer being Ethereum. That is the essential ethos of the Ethereum name service, or ENS. You can purchase a .eth top-level domain from ENS, and fees are paid in ETH. Your domains then become not only usable websites, but tradable assets. ENS domains are traded on large NFT trading platforms like OpenSea and LooksRare. In fact, secondary market trading of ENS domains is healthy. That's good to hear. According to Non-Fungible, over the last 7 days, ENS was the 15th most traded project. That actually is a surprise to me and nice to see. And the 27th most traded project of all time. The number of ENS domains created to date has grown exponentially, but still scratches the surface of possible market penetration. Every Ether wallet with a non-zero balance is eligible to purchase one or more ENS domains. Anyway, so I mean, imagine that you are a squatter on one of these domains like Amazon.eth or whatever. I don't remember what the character limit is. I'm not getting into that. It's the specifics. But if you hold one of these and I mean, it does look like ETH is going to be the financial infrastructure backbone of Web3, or at least a huge piece of it. I mean, we don't really have successful or adopted Bitcoin smart contracts or anything else that can really compete in parallel to the scale that we're seeing of adoption of Ethereum, as was mentioned here. So far, Ethereum looks like it's winning. I mean, so having some of these is something that is could potentially be quite lucrative in the future, but they do expire. You can pay for several years in advance for these ENS domains, but you can see why they're quite popular for those who are forward thinking about Web3. So I guess he's very interested in ENS. He gets into NFTs here, so let's get into that. Art and culture is slinging JPEGs. Art and culture is an expression of human civilization's abundance. Art at its core ingests scarce resources and produces objects and experiences whose only purpose is to provide enjoyment. The surplus of our society's labor is used to purchase and consume paintings, sculptures, music, film, theater performances, television, sporting events, delicious Epicurean delights, etc. Apart from fueling our bodies and reproducing, what's the point of existence if we can't enjoy the art that the creatives amongst us produce? The arts consume a vast amount of resources, and many a billionaire has been created providing culture to the masses. Contrary to popular belief, NFTs, non-fungible tokens, are not art. What they really are is a public blockchain-enabled object/data structure that allows for the digitization of culture. While popular culture synonymizes NFTs with digital art, NFTs are just the object that allows culture to be digitized, made scarce, and traded. Thank you. Thank you, Arthur. The unfortunate but also fortunate fact that NFTs are derided by mainstream financial institutions as people traded easily copied JPEGs illustrates a fundamental misunderstanding of what NFTs are and what activity they enable. The first popular expressions using this new technology, which some consider vulgar, are ugly, pixelated profile pictures produced by algorithms and traded as discrete digital objects. Where the NFT asset class ends up in 5 or 10 years is completely unknown and will look nothing like today. Absolutely. Since the summer of 2021, when trading volumes first exploded higher on OpenSea, billions of dollars worth of these digital objects pinged back and forth between digital wallets. My brother is going to be coming over and we're going to have some tea and crumpets. Actually, let me take a sip of tea. No, we're going to have a nice evening together. I don't even know. We've been playing a lot of Elden Ring, which is fun. If you guys are into Elden Ring, holla in the comments. OpenSea is a centralized company that operates an exchange that allows the non-custodial trading of NFTs. In exchange for fostering a market, OpenSea charges a healthy commission. Oh yeah, and they go down all the time. Due to its first mover advantage, OpenSea commands anywhere between 80 to 90% of the entire trading volume of NFTs. It's a great business, but one which is privately owned. Boo. The technology that underpins how NFTs are traded does not require centralized operators such as OpenSea. LooksRare appeared and offered a community-owned, decentralized marketplace for NFT trading. The trading and royalty fees went to the Looks DAO. Oh, this is new to me. See, this is something I might have missed. And all this LooksRare. Looks governance token holders could then vote on how to best distribute them. Therefore, holders of Looks can directly participate and benefit from the explosion of the digitization of culture, whereas previously users were just customers of a centralized entity. I like that. So he seems to be a fan of LooksRare as an alternative that is decentralized to OpenSea. So this was almost worth reading the entire thing. Looks. What do you guys think? Are you guys into Looks DAO? Are you guys participating? I really want to know about the drawbacks. What is wrong with Looks? Let me continue to read here. Actually, looking at the chart, LooksRare is a solid number 2 behind OpenSea. Long live the duopoly. The tightening of global liquidity inspired by central banks bludgeoned the value of the NFT complex as well. Prices for various NFTs cratered alongside trading volumes. Many mainstream financial pundits essentially laughed at us for thinking these JPEGs would be immune from rising interest rates. I suspect that those who gazed into the starry night and tried their hand investing in NFTs got third-degree burns and now feel embarrassed that in their search for alpha, they resorted to slinging JPEGs. As these masters of the universe must face a quarter-end crescendo of losses, they want no remaining evidence in their portfolio that they too engaged in this madness. They don't even want to talk about it. That is amazing news because it has led to Looks getting absolutely slaughtered in the recent downturn. This is the life to death chart. Okay, so it's been slaughtered. PE ratio. Do you guys are you guys interested in this stuff? I don't know if you're interested. Anyway, so I guess check out the link if you want to read more about Looks. I'm not going to be just buying stuff anymore. I'm going to really wait for a nice bottom, but that's one I would like to keep my eye on, and I might read after this to get some more information on Looks itself. You know what? Maybe I'll just read it. Let's just go ahead and read it together. That way, if you are listening to this like a podcast, you will hear what I will read, and you don't have to do it yourself. That was the whole point of reading this, so that you don't have to, and you can just get it in the Audible format. So it crashed. Looks listed in January 2022 at $2.6 and now hovers around 17 cents, which is a decline of about 95%. The all-time high was $6.87, meaning it is down 98% from the top. Wowzers! What a return in only 6 months. While the price performance is disastrous so far, Looks fundamentals are strong. It is the number 2 NFT trading platform by trading volume. Remember, protocol revenues are available to token holders. Therefore, its price to earnings ratio is dirt cheap. Ooh. Keep talking, or keep reading, keep writing. 2 times to 3 times earning is an amazing valuation for a protocol that could be one of the dominant exchanges of human culture on the internet. This is the first real market cycle for tradable NFTs. It is completely rational for the businesses connected to this sector to experience 98% drawdowns from the recent all-time highs. The issue of the worthiness of one form or culture versus another is deeply personal. People get meta triggered when something they consider worthless is ascribed high values by others. How many people scoff at how some scribbles on a canvas are worth millions of dollars? This pathos will continue to drive insane volatility in any protocols related to the intersection of human culture and public blockchains. As Looks is just a call option on an uncertain future, the bigger the volatility, the larger the intrinsic value of the option. So the fact that the trading volumes and prices are down has not dented, which they're down, has not, as you might not be able to see on these charts, but they are, has dented the enthusiasm of those in the business of selling culture from appreciating how impactful NFTs will be to human society. Anyone directly involved or adjacent to the arts is desperately trying to figure out what NFT technology means for their practice or business model, or just in general, right? NFTs will not perish, and their disruption to the economics of culture will be profound. All the while, the press is focused on those silly individuals and businesses that thought they could get rich quick flipping JPEGs. If that is denting investor enthusiasm for an exchange that is the number 2 place where digital culture is traded, please keep spewing that nonsense. Yeah, making it cheap for the rest of us. I will be there with my ape diamond paws, scooping up cheap Looks for a long time. When Looks, Looks, when the market narrative shifts down the line, these top platforms will be the pinnacle of how culture is traded. Yeah, you've said that. And the PE multiple expansion will be glorious. I'm sure that many readers can point to areas of improvement in the business model or technology, but as natural monopolies go, the game is basically over for the global NFT marketplace. It will be very difficult to supplant OpenSea or Looks Rare. Liquidity begets liquidity, and if the community owns a platform on which the majority of assets they ascribe value to trade, then why would the community have any reason to try out a new competitor? Why would anybody go to a Twitter competitor if Twitter is working just fine and that's where everybody's at? Why do I stay on YouTube even though I'm supposed to be on 3Speak, right? Or whatever you guys suggest. Why am I still on YouTube? That's kind of what he's getting at. As anyone who has actually tried to sell an NFT knows, liquidity on the exits is severely lacking. As a result, it is better to sell on the number 1 or 2 platform. And actually, real quick, my friend who's quite popular on TikTok is like, why don't you just jump on TikTok? You're gonna get so many followers. Just jump. Because to me, it really is about quality over quantity. And even though I only have this many users, we only have 16 concurrent viewers. And thank you so much. I invite you to hit that like button. Please, we need it. We're desperate these days in low volume. I think actually we're at 19 concurrent viewers now. So just looking at it, giving it attention makes something grow. That's like fundamental to the consciousness of the universe or something or whatever. I don't know. I think so. That's why that happened. I look away, we're down to 18. But I do feel like I have a great quality community here and way better than I can get on TikTok. But I could be completely wrong on that. But I right now have a great quality to poop ratio. So where was I? Yeah. He said out of all the tokens analyzed in this essay, myself included, I agree with what he's going to say. I am most excited about looks. If what he's saying is true, now maybe he's wrong. Maybe he's misleading us here, and there is a second place most traded NFT marketplace. But why would he do such a thing? He's talking about buying the leaders here. So he's most excited about looks, and that's what I'm most excited about in this article so far. It is part of a small cadre of platforms that are creating the market for the tradability of human culture. Many will look back at this summer and rue their insistence on allowing the filth of mainstream financial pundits to infect their token selection process. Oops. I did it again. Oops, I did it again. I played with TA, got lost in the game. Oh, baby, baby, oops, you think I'm in love, and I'm sent from above. I'm not that prescient. When it comes to calling the market, I get it wrong more than I get it right. That's the difference between writing essays and investing. My Bitcoin $25,000 to $27,000 and Ether 1,700 to 1,800 bottom range proved to be extremely optimistic. Oh well, as I wrote this piece over the last fortnight, I became a little less convinced that my Ether call would hold up in the face of my theory that hedge funds will continue puking out anything DeFi related. Well, Gabriel has arrived here. So thank you so much for joining me so far. We're about to wrap up here, Gabriel, but I'm gonna go ahead and just speed through the here at the ending and not dilly daddle too much.
Say hello to the people. Hello, people.
Yeah, you gotta lean in a little bit
Oh
more.
yeah, let me get next to Kiwi. Then you can't see me.
They
Hey,
can
what's
see
up?
your eye and half your stash. That's perfect.
You see. So like
Kiwi's
it's like,
gonna bite your face off.
it's like
now.
a look. If you look at it, it looks like I'm just like a floating head on top of a stack of books. Hey, what's going on?
Kiwi doesn't play games. Kiwi doesn't
Yeah.
play games.
Kiwi's pissed because I left the block for a day or two.
Yeah. So, okay. As I wrote this piece over the last fortnight, I became a little less convinced that my Ether call would hold up in the face of my theory that hedge funds will continue puking out anything DeFi related. While I'm not going to outright sell Ether for filthy fiat, given that I continue to carry a large implicit through ownership of ERC20 tokens or explicit Ether exposure, I dabbled in more out of the money puts. I started with the purchase of Ether puts with a September 2022 expiration and $1,500 strike price. Just for completeness, I also purchased some Bitcoin puts with the same expiration and a $25,000 strike price. I closed these a bit early and I didn't fully participate in this week's dump fest. But that is why I keep my sizes relatively small. Babysitting my Bitcoin, I ain't about that life no more. The US CPI for May hit a fresh 40-year high of 8.6% year over year. The politics dictate that the Fed must go larger and longer with rate hikes. We saw that yesterday with a historic 75 basis point hike by the Fed. I suspect the political pressure for the Fed to be perceived as fighting inflation won't let up until after the November US midterm elections, at which point it becomes a fight for the 2024 presidential election. The Democrats will most likely lose the House of Representatives and the Senate, which creates a lame duck 2-year stint for the Biden administration. Nothing will get passed, and all political energy will be focused on what narratives play well to voters in 2024. The number one thing that American voters care about is their personal finances. Juicy the markets, both employment and financial, will win votes. The easiest way to accomplish both of these goals is to print money. While the long-term effects are deleterious, that's the next administration's problem. Therefore, watch how quickly the Biden administration pivots in its messaging. From the Fed must tackle inflation to the Fed must ease financial conditions so that the American jobs can be created. With POTUS at his back, the President of the United States at his back, the Fed can get back to business as usual, money printing. So cool. He's calling November for money printing season. And AK crypto going back up. So this could be good opportunities to buy. Crypto valuation equal technology plus fiat liquidity. I mean, he might be right if we are in that lame duck situation. So I mean, I'm calling it a year. Why not? The fiat liquidity situation will be brutal for the next 6 to 12 months. It is during this period that we shall discover what multiple the market ascribes to what the faithful believes is game-changing tech. This game-changing tech previously commanded a very high price-to-metrics ratio. For the foreseeable future, the ratio will be sliced and diced to unimaginably low levels. As I hope the preceding analysis highlighted, there are critical DeFi verticals that are on sale right now. If you believe in the fundamental premise that the number of addresses will continue growing, then certain projects with revenue accretive models at the protocol level will still exist and even grow during this nuclear bear market. These tokens will likely continue getting smacked as hedge funds and other crypto businesses liquidate positions amidst being wound down or severely curtailing their activities. For a real asset allocator, this is planting season. Once the rainy season filled with fat droplets of central bank liquidity begins, then it becomes difficult again to procure desirable projects at reasonable valuations. The rewards to the intrepid investor will soothe the market-to-market pain experience from now until the beginning of the next bull cycle. Please internalize this statement if you believe I can somehow attempt to call a bottom in any of the shitcoins I just analyzed. These tokens could fall another 50% or more, and I would be even more excited to own the premier DEXs, exchanges that enable the tradability of human culture and one of the backbones of a decentralized internet. As the market marches lower and lower, as long as I believe the usage of these services will continue to grow into the future, then my average entry price gets lower and lower, and my effective yield, protocol revenue / fully diluted market cap goes higher and higher. So he's basically saying he isn't calling a bottom. He would be happy to buy them lower than this, but he's waiting for that nice Fed liquidity like the rest of us. He's saying it's going to happen after the midterm elections here in the United States, when it's going to be way cooler to instead of saying, hey, inflation is bad, instead say, hey, you need to save these markets. And that is when we're going to get risk assets partying, and you want to buy these things that are oversold, that have good price to earnings, whatever, just quality projects. Actual users. Number 2, NFT marketplace. You want to have these things when they're cheap, and so he's seeking to buy these things, although he is also messing around with dangerous options and trying to call that. But that's Arthur Hayes, the master of the mercantile of the Mexico, of BitMexico, as Eric Crown. I think just an awesome guy and a great trader, it says on YouTube. Anyway, thank you so much for joining me today. Thank you, Henry Bryan. Thank you, Gabriel. Thank you, Dreamcatchers. Whoever else I'm missing, staff. Vic already said, Mr. X, Pothead, Azam. I get to actually greet everyone who's joining us here live, since there's not many. And I love the quality again. I love having a smaller viewer base in a way. So take care, everyone. Thanks again to Peter Louie for being a new Patreon. Thank you to Michael Wasserman for his tip. Thank you to the other Michael who's tipped me again, and to the rest of you who just tune in. That means the world to me. Take care, much love, and